Title: The Subprime Mortgage Crisis. Maverick's comprehensive examination of causes, effects, and policy changes. Introduction. The subprime mortgage crisis, a devastating financial disaster that spanned from 2007 to 2009, left an indelible mark on the global economy. It resulted from a confluence of factors, including lax lending standards, financial innovation, and regulatory failures, culminating in a housing market collapse and the loss of trillions of dollars in wealth. This crisis prompted significant changes in U.S. policies and facilitated widespread reforms in the financial sector. Causes. 1. Lax lending standards. Eager to increase market share and spurred by the belief that housing prices would continue to rise, financial institutions began offering mortgage loans to subprime borrowers, individuals with poor credit histories or insufficient incomes, making them high-risk candidates for loans. These loans often took the form of adjustable-rate mortgages, ARMs, with low initial interest rates that reset to higher rates after a few years. The widespread availability of subprime loans led to an inflated housing market, as more people could now afford to buy homes. 2. Financial innovation. Securitization and the development of mortgage-backed securities, MBS, facilitated the distribution of subprime mortgages throughout the financial system. Banks and other institutions pooled mortgages and sold them as securities to investors. This process spread the risk associated with these loans but also created a disconnect between mortgage originators and the ultimate holders of the risk. Complex financial instruments, such as collateralized debt obligations, CDOs, and credit default swaps, CDs, further contributed to the proliferation of risk throughout the system. These instruments allowed investors to bet on the performance of mortgage-backed securities and even profit from their failure, creating perverse incentives. 3. Regulatory failure. Regulatory agencies, such as the Securities and Exchange Commission, SEC, and the Office of the Comptroller of the Currency, OCC, failed to identify and address the risks associated with subprime lending and the securitization process. Credit rating agencies, responsible for assessing the risk of MBS, gave many of these securities high ratings, which were later proven to be inaccurate. The agencies' reliance on outdated models and their close ties to the institutions they were supposed to regulate contributed to the crisis. 4. The housing bubble. The influx of subprime mortgages, combined with low interest rates and a strong belief in the infallibility of the housing market, contributed to a rapid increase in housing prices. This speculative bubble was fueled by the expectation that housing prices would continue to rise, making it an attractive investment for both individuals and financial institutions. 5. Government-sponsored enterprises, GSEs. The involvement of government-sponsored enterprises like Fannie Mae and Freddie Mac in the mortgage market contributed to the crisis. These GSEs purchased mortgages from lenders and sold mortgage-backed securities, providing liquidity to the mortgage market. However, their implicit government backing and their focus on promoting homeownership led them to invest in riskier mortgages, amplifying the impact of the crisis. Effects. 1. Housing market collapse. The crisis led to a sharp decline in housing prices, as a wave of foreclosures and an oversupply of homes flooded the market. Home values dropped significantly, and many homeowners found themselves underwater, owing more on their mortgage than their property was worth. The collapse of housing prices was most severe in regions where speculative investment had been rampant, such as Las Vegas, where prices fell by more than 60% from their peak. 2. Financial sector implosion. The collapse of the housing market led to massive losses in the financial sector. Numerous institutions, heavily exposed to mortgage-backed securities and other risky assets, either failed or required government bailouts. Prominent examples include Lehman Brothers, whose bankruptcy was the largest in U.S. history, Bear Stearns, which was acquired by J.P. Morgan Chase in a government-backed deal, and insurance giant AIG, which received a $182 billion bailout from the U.S. government. Smaller banks and financial institutions were also impacted, with over 450 banks failing between 2008 and 2010. 3. Global recession. The crisis spread beyond the United States, causing a global recession. Financial institutions around the world experienced losses and tightened lending, which led to reduced investment, job losses, and economic contraction. The International Monetary Fund, IMF, estimated that the global economy contracted by 0.6% in 2009, the first decline in global output since World War II. Countries like Spain, Greece, and Ireland experienced severe economic downturns and required assistance from the European Union and the IMF. 4. Loss of wealth. The subprime mortgage crisis led to the evaporation of trillions of dollars in wealth. Homeowners, investors, and financial institutions all suffered massive losses, with the total cost of the crisis estimated to be around $10 trillion. Pension funds, retirement accounts, and individual investments were all severely impacted, leaving millions of people with diminished savings and financial security. Additionally, the crisis undermined public confidence in the financial system and led to calls for greater accountability and transparency. Policy changes. 1. The Dodd-Frank Wall Street Reform and Consumer Protection Act. In response to the crisis, the U.S. government enacted the Dodd-Frank Act in 2010. This legislation aimed to strengthen financial regulation, increase transparency in the financial sector, and protect consumers from predatory lending practices. Key provisions included the creation of the Financial Stability Oversight Council, FSOC, to identify and monitor systemic risks. The establishment of the Orderly Liquidation Authority, OLA, to wind down failing financial institutions in an orderly manner. And the implementation of the Volcker Rule to restrict risky trading activities by banks. 2. Enhanced capital and liquidity requirements. Financial institutions are now subject to stricter capital and liquidity requirements, designed to ensure they have enough resources to withstand financial shocks. These requirements are part of the Basel III international regulatory framework, which was developed in response to the crisis and adopted by the U.S. and other countries. 3. Creation of the Consumer Financial Protection Bureau, CFPB. The CFPB was established under the Dodd-Frank Act to protect consumers from abusive financial practices. The agency is responsible for regulating consumer financial products, such as mortgages, credit cards, and student loans, and has the authority to enforce consumer protection laws, conduct investigations, and impose penalties on financial institutions that violate these laws. 4. Housing market reforms. The government implemented various reforms to promote responsible lending and reduce the risk of future housing bubbles. These measures include the Ability to Repay Rule, which requires lenders to verify borrowers' ability to repay their loans, and the Qualified Mortgage (QM) Rule, which establishes minimum underwriting standards for mortgage loans. Rescuing the market. 1. Government bailouts and interventions. The U.S. government and the Federal Reserve took several measures to stabilize the financial sector and rescue the market. These included the Troubled Asset Relief Program, TARP, which provided financial assistance to banks and other institutions, and the implementation of several rounds of quantitative easing, QE, to inject liquidity into the economy. The Federal Reserve also lowered interest rates to near zero levels to encourage borrowing and stimulate economic growth. 2. Housing market support. The government implemented various programs to support the housing market, such as the Home Affordable Modification Program, HAMP, which aimed to help homeowners avoid foreclosure by modifying their mortgage terms, and the Home Affordable Refinance Program, HARP, which allowed homeowners to refinance their mortgages at lower interest rates. These programs, though criticized for not reaching as many homeowners as initially intended, did provide relief to millions of struggling borrowers. Initiatives like the Neighborhood Stabilization Program, NSP, were also introduced to revitalize communities hit hard by foreclosures and to prevent neighborhood blight. 3. Regulatory reforms. As mentioned earlier, the implementation of the Dodd-Frank Act and other regulatory reforms aim to prevent future crises. By strengthening oversight, increasing transparency, and reducing risk in the financial sector. These measures included the enhancement of the SEC's authority to regulate credit rating agencies, increased oversight of derivatives markets, and the implementation of stress tests to evaluate the resilience of large financial institutions. 4. Economic stimulus. To combat the recession and encourage economic growth, the U.S. government enacted several stimulus packages, including the American Recovery and Reinvestment Act of 2009. These packages focused on infrastructure investment, tax relief, and support for struggling industries, such as the auto industry, which received an $85 billion bailout to prevent the collapse of major automakers like General Motors and Chrysler. The stimulus measures were credited with creating or saving millions of jobs and laying the foundation for economic recovery. 5. Global coordination. The crisis highlighted the need for greater international cooperation and coordination in addressing financial challenges. The G20, a group of 20 major economies, played a crucial role in coordinating a global response to the crisis, including fiscal stimulus measures, financial sector reforms, and support for emerging economies. The crisis also prompted efforts to harmonize financial regulations across countries and strengthen the global financial safety net. Conclusion. The subprime mortgage crisis was a complex and multifaceted event with far-reaching consequences. The combination of lax lending standards, financial innovation, regulatory failures, the housing bubble, and the involvement of government-sponsored enterprises led to a housing market collapse, the implosion of the financial sector, and a global recession. In response, the U.S. government implemented a series of policy changes and interventions aimed at stabilizing the economy and preventing future crises. These measures included regulatory reforms, financial sector bailouts, housing market support, economic stimulus packages, and international coordination efforts. While the full recovery from the crisis took years, these actions laid the groundwork for a more resilient and better regulated financial system, aimed at safeguarding against future crises of this magnitude.